Hello everyone, I am Divya Grover, here to help you take informed mutual fund investment decisions. American author Earl Nightingale once rightly said, "The foundation of a good retirement is planning." Retirement is an unavoidable stage of life that requires careful planning. Most of us look forward to enjoying our golden years blissfully, traveling, pursuing hobbies, and spending time with loved ones. But to be able to live a joyful retirement, financial preparedness is a must. A well-planned retirement requires disciplined investing that can generate inflation-beating returns. Mutual funds are a smart and convenient way for building a retirement corpus. They offer investment options across various asset classes, allowing you to create a portfolio that suits your risk tolerance and investment timeline. In this video, we will list 4 worthy types of mutual funds that can help secure your retirement. Number 1 is equity mutual funds. If you are at least 7 to 10 years away from retirement, you can afford to take on risk. In this case, you may consider allocating 75 to 95% of your investment to diversified equity mutual funds to earn significant long-term returns. Equity mutual funds invest in stocks of listed companies with an aim to generate meaningful long-term and inflation-beating returns. Depending on their objective, these funds may focus investments on large cap, mid cap, small cap, or opt for a multi-cap strategy. Based on your risk tolerance, you may consider investing in a mix of large cap funds, flexi cap funds, mid cap funds, small cap funds, and value funds. You may be better off avoiding high risk categories such as sector and thematic funds. Equity mutual funds tend to be volatile in the short term but may potentially compound your wealth over the long term. Number 2 is hybrid mutual funds. Hybrid funds invest in a mix of equity, debt, and sometimes gold within a single scheme. These funds manage risk by balancing investments between different assets depending on the market conditions. The equity component in the scheme offers growth potential, while the debt portion helps in risk mitigation. These schemes may offer better protection against downside risk during bearish market phases. For your retirement needs, you may consider hybrid categories such as aggressive hybrid funds, multi-asset allocation funds, balance advantage funds, and conservative hybrid funds. If you prefer an aggressive investment approach, you may consider equity-oriented hybrid fund such as aggressive hybrid funds. However, if you wish to opt for a conservative strategy, you may consider debt-oriented hybrid funds such as conservative hybrid funds. Number 3 on our list is debt mutual funds. As you approach a retirement, your portfolio should become more conservative. Debt mutual funds invest in fixed income instruments like corporate bonds, treasury bills, and certificates of deposit. These funds offer relatively stable returns and are less volatile than equity funds, making them suitable for investments nearing their retirement. Debt fund categories that may be worth considering for retirement planning include liquid funds, banking and PSU debt funds, dynamic bond funds, corporate bond funds, and gilt funds. Those close to retiring may allocate 40 to 50% or more to debt funds, while those still a few years away may limit the allocation to 20 to 30%. These funds can act as a cushion during market downturns and potentially protect your retirement capital. Number 4 is gold ETFs. Gold ETFs are mutual fund schemes that invest in physical gold and aim to track domestic gold prices. Each unit of ETF represents 1 gram of pure gold. Investment in gold offers you a hedge against inflation, geopolitical risk, and equity market volatility. This is because gold often shares low correlation with equity market. Gold ETFs are cost-efficient and liquid way of getting exposure to gold. They also eliminate the risk of holding physical gold, such as theft or concerns regarding purity. Investors may consider allocating 10 to 15% of their retirement corpus in gold ETFs for diversification. Including gold can help reduce overall portfolio risk and ensure stability during economic uncertainty. Moving on, when you invest in mutual funds for retirement, keep the following things in mind. The first step is to start early. The earlier you begin, the lesser amount you will need to invest regularly to achieve your retirement goal. The second step is to use a retirement calculator. This will help you estimate how much corpus you will need and how much to invest monthly. Thirdly, prefer the SIP mode of investment, which offers a disciplined mode to building long-term wealth. Moreover, consider increasing SIP contributions annually as your income grows. The next step is to diversify and smartly allocate investments across equity, debt, hybrid, and gold based on your risk profile and time horizon. And finally, timely rebalance your portfolio. When you near your retirement, gradually shift assets from equity-heavy investments to more stable hybrid and debt funds. This brings us to the end of the video. Successful retirement planning is more than just saving. It involves investing smartly across the right mix of asset classes. If you're many years away from retirement, you can afford to take more risk and focus on equity-oriented funds. However, if you're close to retirement, prioritize capital protection and income stability through debt and hybrid funds. By building a diversified and well-planned mutual fund portfolio, you can achieve financial independence and retire with confidence. So start early, stay consistent, and review and rebalance your portfolio periodically. For more guidance on mutual fund investments, subscribe to our YouTube channel. If you like this video, please give a thumbs up and share it with your friends and relatives. Signing off for now. Happy investing. Mutual fund investments are subject to market risk. Read all the scheme related documents carefully. Registration granted by SEBI, enlistment as IF with exchange, and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.